Right, next up, we're going to go and tackle opening plays. So these are trades that you can take straight at the open. Now, this doesn't necessarily mean literally as the market opens, click, but in some circumstances it will. And in order to take trades like this, you have to understand what's going on at an open, how new positions are coming in, how old positions are squared up, and how the market has got to where it is opening. This is going to give you a huge amount of information about what potentially could come next, what trades you can take on the back of this, how you're going to go about playing some of these trades. Now, one of the things that I think is so important when thinking about opening trades is that there is a lot of uncertainty. If there's any period of the day with the greatest uncertainty, it's at the open, because everyone's coming back in fresh again. Whereas an hour, 2 hours into the day, you've at least got some understanding of how the market is beginning to trade. Whereas at the open, it is very, very uncertain. And so for that reason, you don't want to be rushing into things. There's no need to take trades or find trades at the open because you feel you should. The other factor with an open is that it will naturally bring in more volatility. And so the surge of people taking on positions is going to increase volatility, which is also very attractive. This is easy to get sucked into. It's easy to think, oh, there's a trade. And with that being the case, again, you need to be very clear and very certain as to what it is you're looking for so you can deal with this uncertainty. So we're going to look at different scenarios and how they play out. But first off, it's about understanding what's happening at the open. So we're going to look at different opening types to start with. Right. Your opening type ultimately is your initial balance. I mentioned this a few times already. Your initial balance is the first hour of trade, or for whatever period you're looking at, the first 2 TPOs of the day. And I'll talk about different variations on this in a moment. But what you're trying to deduce from this, or what information you're gaining from this, is the first action of the day. And so it's the first intention. People come in, they start to click, stuff starts to happen. And as that's happening, this now is giving you information about who is participating. Because what you are going to see, essentially, is a market bouncing around. It will move to where it finds sellers, to where it finds buyers. And in doing that, you start to establish what these buyers and sellers are looking like in the early trade. You're also going to see reactions to things. Reactions to where we were trading previously. Reactions to how we traded in the overnight session, or how news is being digested by the market. And all this happens very early on. People aren't going to wait for 2 hours to digest the news that they've just received. They're going to digest it immediately and act, because if they don't, somebody else will. People have positions from previous sessions. These positions may be significantly further offside than they were expecting. They might be well onside, and people are going to react to that. So you get this squaring up of positions as well. And this is all factoring into that sort of initial balance volatility spike of volume that you will get. You're also going to get new orders coming in. People will phone brokers end of previous session overnight and say, if market opens above X or below Y, do Z. And so there'll be orders that come in at the open based on where the market is trading, based on where the market is opening. And we're going to look at order flow perspective and how you actually trade specifically the opening auction when we do order flow and when we do macro trading week. The idea of your initial balance, in that squaring up, entering of new positions, digestion of news, what happens here is you get a base for the day. And we talked about this briefly already, so we won't dwell on this, but we know that a large initial balance, a large normal day, or typically a normal day, is going to contain range for the rest of the day. So you get a limitation of range. Small initial balances give potential for movement. And that's the first thing that you can take for initial balance. Compare them to recent. There's no real value in trying to assign specific nominal sizes to initial balances, because volatility is going to impact that. What would seem a very, very large initial balance in a low volatility environment may actually be a reasonably small initial balance in a high volatility environment. So you have to relate them to what you're currently seeing. Relate your initial balance to the size of previous days. A good kind of measure here would be if you're seeing a 100 tick range typically in whatever market is you're trading, and you get an initial balance that is 50 ticks, you could say that that is erring on the side of a large initial balance, on the basis that if that is going to limit extension of range, limitation of extension would limit you to about 100 ticks. You assume that the initial balance is taking half of the range. So you can compare it to current ranges. You can also compare it to recent initial balances as well. The next question is, when is your initial balance? Now, there's different ways you can look at it. The simple way of looking at it is the first 2 letters of a session. Now, the difficulty that you're getting here is that with 24-hour markets, the main trade does not necessarily happen in the first 2 hours. If you're looking at CME markets, so Globex, the first hour of trade, so the first 2 TPOs, fall bang in the middle of the night for the Europeans. They fall late in the day when everybody's already gone home in the US. And depending upon where you are in Asia, either towards the beginning or the end of their day. So this is not when you're going to get the greatest amount of new information. And as such, an initial balance is perhaps better judged as the beginning of the cash session. And for this reason, currency initial balances generally are less applicable. So to address the cash session, I would typically be looking for the first 2 letters of the cash session. There is a slight variation on this with Eurex. Now, Eurex has what they call a pre-cash trade. Now, for a long period of time, there was no overnight session in Eurex. And so the volume would come in at 7 a.m. until 8. 8 a.m. UK time is when European cash sessions start. So when the underlying indices, the underlying bonds start to trade. And so volume will pick up. But if you look now, the overnight session is low volume. You will then get a very distinct pickup in volume at 7 a.m. followed by the cash session pickup in volume at 8 a.m. So you can look at these as 2 separate initial balances, or you can dismiss the 7 till 8 and look at the 8 a.m. The implication, I think, lies the same. That if you have a large 7 a.m. initial balance, you are unlikely to see much continuation. And so that implies a smaller 8 a.m. initial balance. Or even a wide 8 a.m. within the 7 a.m. initial balance. But they will both generally imply the same thing. So be clear on when your initial balances are. With things like currencies, one way that a lot of people will look at this is to view the initial balance as the overnight session. So all the currency futures trade on Globex, so CME. So they will open at 11 p.m. UK time. One way of viewing the initial balance is to go from the open at 11 p.m. all the way through until the 8 a.m. open of the European cash session, or the 7 a.m. open. Basically look at where the volume picks up and treat that pick up in volume as the beginning of the session, and everything prior to that as the initial balance. So essentially your overnight session up till 7 o'clock in the morning, 7 a.m. or 8 a.m. in the morning, and then after that, or treat that as the initial balance, and then after that your trade for the day for currency markets. So maybe that explains when your initial balance is. So let's go and have a little look at sizes of initial balance and what their implications are. And this also gives you a way of kind of judging what's a large initial balance. What I've got here, 4 separate sessions. Got the split profile so you can see the directional elements of the day, as well as the 15-minute charts. The red marks the range of the day, and the number, the size of the range, and the blue marks the initial balance. And what you can see here is that all of the ranges are reasonably similar. 72, 51, 62, 68. So 51 is the smallest. But what you're noticing is that it's about the initial balance taking away scope of movement. The largest initial balance here, 33 ticks, which is big. Bearing in mind that 33 tick initial balance is more than, or is just shy of 2/3, 1 tick shy of 2/3 of the range of the previous day, is clearly a big initial balance, particularly when the previous 2 were 8 and 10. But it's about looking at what happens outside. Clear direction outside of the 8 tick. Outside of the 10, we use the bottom of the initial balance as resistance, and we do move lower, close at the low. Large initial balance, we trade below, down here, we trade above, and we settle in the middle. So it takes the direction out of the market. It doesn't mean that you don't get movement. And in fact, arguably, you have more movement on this day in terms of extension down, 60 ticks back up, back down the range. Each of these moves is over 30 ticks. You get 30 plus ticks down here, or 40 plus, 60 back up, 40 plus back down, 40 to 50 back down, and then back into range. More movement. Whereas here, you get one clear directional move. So it's clarity of movement versus number of decent sized directional movements. So this is what's important about your initial balances. That don't dismiss a large initial balance as taking the action away, it's taking the direction away that's important to take on. So, moving on from this. Another example where you can see again, the sizes of initial balances don't necessarily impact ranges, and in fact again, the largest range is on the smallest IB extension. So there you go, smallest initial balance, largest extension. The largest range is actually formed on the largest IB. So you get the 60 tick initial balance, that forms the largest range. But the clearest direction comes on the back of the 9 tick initial balance, straight line up. So again, just illustrates that point that there's your 9 tick initial balance, there is your clear straight move. Whereas here's your 60 tick initial balance, and you then get, and bearing in mind what I previously said, this produces the high and low of the day. You don't know which, and with this one, it's actually up to start with, yet we break back through there, and then we balance below. So that's the range extension just here, but it's actually done below the initial balance compared to what you might have thought, seeing as it goes towards the upside. Just having a sip of coffee. Restart. So let's go have a look at 4 different open types, and really this is all there are. Everything will fall roughly into one of these. Some are going to be very, very obvious, some are not. And there is one, I'll talk about this in a moment, that I think is your kind of catch-all. If it's not any of the others, it probably falls into that one. Now what you're trying to take from your initial balance, and by defining what type of open it is to be very clear on what you expect the rest of the day to bring, what it tells you. So along with the size of the initial balance, which limits clear direction for the rest of the day, you've also got the element of the direction of the initial balance as well. And this falls into 4 types. You have an open drive. This is your high conviction. And we're kind of moving down the conviction level as we go down. Open drives, high conviction. It's one directional, you will open and move in a straight line from there. So typically the opening price will be very, very close to the low of day, or high of day, whichever way it goes. This will typically form the extreme of day and sets the tone. Conviction is high. These types of moves can often also lead to normal day types because they will often create a very large directional initial balance as well. But it sets the tone, it tells you where the conviction is, and the conviction is clearly one directional. You're looking then for a break of the initial balance to continue directional movement. Next up then is your open test drive. This is still reasonably high conviction. What happens with an open test drive is that from the open, you will trade to a reference point. So think responsive trade, responsive trade, and then drive in the other direction, initiative. What's happening here then is you're getting conviction, but what you see is that we test conviction one way first. So maybe this could be a scenario, and it's a common one where you would open above value, inside range, trade back to value, there's your test, find responsive buying, and drive up, and there's your initiative. So open, test, drive. Now, of course, on the test part, you don't know that that's going to be an open test until it goes back through the open, and that's the critical part of an open test drive. What it does do is it shows you that some traders in one direction cannot maintain their movement or maintain direction, and so therefore the market can go back in the other. Next up, you get an open reject reverse. This is perhaps more your catch-all. What this does is you have a market that trades one way, so it looks like an open test, drive back, but then fails to maintain that direction either. So it does have conviction, but it's more balanced conviction. People are happy to try one way and try the other. And so the important bit here is whilst these two set the direction very clearly, your open drive, open test drive, open reject reverse doesn't. Your open reject reverse suggests that when the initial balance breaks, whichever way it does, that side essentially takes control. They hold the conviction and are able to carry movement onwards. It will still, though, typically lead to a more rotational day because the inability to establish conviction early is always going to put in doubt any continuation. And so therefore, you will get a situation where the market will reverse back and roll back on itself multiple times because it is more able to do so on the basis of that lack of early conviction. And finally, your open auction. This is a complete non-conviction move. Now, these ironically will turn into either a neutral day, i.e. a day that does nothing, or a trend day, where conviction establishes on the break and is then maintained. But initially, you're typically going to see an open auction whereby the market will open, it will trade above and below the open multiple times within the first hour. This tells you that people don't know what they want to do. That the market is basically bouncing between a larger time frame seller and a larger time frame buyer, and people are happy to bounce it between the two, neither of which show initiative to push the other one out of the way or to drive the market one direction or another. Everybody from the beginning of the day is happy in terms of where the market is, and as such, people are unlikely to change perspective as the day goes on. So just to give you an example of what we're looking at here, here's your open drive type scenario. You will have opens towards the extreme, and from there you're then looking at the size of the initial balance is critical. Direction's established, we know where we're going, but what's important now is how the market can continue on from here. The larger it is, the more normal day that you're looking towards, the smaller it is, so it establishes clear direction. Then as that conviction comes on the break, this is where you can turn into a trend, a liquidation, a normal variation type day. So we have clear direction, you're waiting for the size to either limit or enhance movement for the rest of the day. You open, test drive, similar type concept. The crucial bit is that we try a reference point, whether this be a previous high, top of value, single prints, a close, whatever it is, you get a trade to a previous reference point and the market goes back through the open. Crucially, once back through the open, you don't want to see it back down here. That's the drive part, and that should be maintained. Now, the end of the initial balance doesn't necessarily have to be at the extreme, and typically isn't. But you're looking at generally, you've had two moves, open, test, drive, and that is all. What you don't want to be seeing is multiple movements here, because that then changes the directional conviction and moves you more into an open, reject, reverse, which is where you get an open, test, drive, reverse, essentially. So we open, we reject one way, we go back, and then we reverse. So what this effectively does for you is it shows people are willing to send the market one way, but they can't maintain that. And then equally, when it comes back, that can't be maintained either. Whereas if this is an open test drive, this move would be sustained. The market would then take directional bias to the downside. We don't get that. And so the important piece of information you're looking for now is which way we break the initial balance. And then finally, you open auction. This is one where we will trade across it multiple times. More times you trade across it, the less and less conviction is shown. You're going to see market generally not a massive initial balance, size-wise, generally quite small. And the only way that this really is going to change is on the escape of the initial balance, so here, or here, or more so on the first escape. This, if it is to be anything other than a neutral day, needs to drive out. You need to see a distinct change in the way it trades here and trade to then establish at a higher point to keep the move going. If that doesn't happen, and doesn't happen quickly, the move is over and it is not going to materialize for the day. You can very quickly assume that you're going to fall much more into a neutral or balanced type day. What you also can have is a little clue, because you don't always want to wait a whole hour to try and work out what it is, particularly if you're going to have a large initial balance, because by the time you've decided whether this is an open drive or an open test drive, much of the move has gone. So there's another way of approaching this to try and enable you to be part of those smaller moves, or part of the initial balance move, rather than having to wait an hour to trade. It can become frustrating, and there are very clear opportunities within an initial balance that you can be taken advantage of. And so by looking at things from the perspective of an opening range, this enables you to then draw conclusions within the initial balance and play for one of the four initial balance types. The difficult part of an open range is that it's hard, there is no clear definition. So whereas with an initial balance, you can say, right, the first two TPOs, for the first two letters of the day, there's your initial balance, that's clearly defined. The opening range, or opening auction some might call it, is essentially the first movement in one direction and then the other, which establishes the first high and low of the day. This is where you've essentially found the first responsive trade one way and the other. And even with an open drive, this is quite typical. Realistically, this is something that you're expecting to be able to see within the first 5 to 10 minutes. If you're getting beyond 10 minutes and you can't see the opening range, you're probably overcomplicating what you're looking for. I think is perhaps the best way of looking at that. It should become pretty obvious, should become pretty clear. This is something to test out for the next few days. Look at what your opening ranges are. Establish very quickly, or try and establish and get a 1 minute chart up and draw where you think the opening range is. This way you can then look at the break and then compare the break of that opening range as to what type of initial balance you get. This is a great way to understand the, the creation of certain types of initial balance. It also enables you, of course, to be able to play within the initial balance. So what I've got here is an example, each in the S&P, so same market over a reasonably similar period of time, so all within 2 weeks of each other. So volatility is around about the same in all of them, so you can see a reasonably close comparison of action. And what we've got then is an open drive, open test drive, open reject reverse, and open auction. Now, each of the blue lines I've used to show the opening range and then what happens from there. Because what's very important here is whether you come back inside the opening range or not. So if we take the open drive, there's your open, it's a straight move down. So your opening range is established after about 5 or 6 minutes. Once you get a bounce, this essentially gives you a move that goes down and up like that. Once you've got that, you can say, right, well, there's clearly the low. The fact that you have gone straight down would suggest that this may well be an open drive. And as such, you can then assume that that is your opening range here to here. On the back of that, you can then play the break of the low, and you're going to be looking more in the direction of the first move to play for the open drive. There's the end of the initial balance. So nice straight line move, open to close, closes virtually at the low. In a way, it's a mini trend. And you can be part of that. You see the first pullback break. There's your opening range, open drive play. With your open test drive then, we open, and this is the thing with an open test drive. The assumption is that it will go straight one way and back. Whereas here we open, there's your opening range. And often the opening range makes this much easier to understand. There's the move down, here's your test, and then we go back through the open and up. This takes you outside the opening range. And so once this open range breaks up here, this is where you say, okay, now we've seen the test, there's the drive, this is an open test drive. It puts in a reasonably big initial balance, so you get 40 handle initial balance. This is when volatility is reasonably high. So 14's up towards 53. This one, you get 37 all the way down towards 80, so you're getting just shy of a 60 handle initial balance there, 57 or 56 handles. But there's your open test drive. Here then, looks like an open drive. Open, little spike up can form the top, drop down, bounce, and so again, like the open drive, we traded down, we bounce. At this point, you say, right, there's my open range, established within about 3 minutes, and then it breaks. So here, you can look at that and assume that this could be another open drive. And it's only when you come back inside, and clearly you'll be wrong and stopped out if you play this. You come back inside, now it's looking like an open reject, and then it reverses again, open reject, reverse type move. But you can start to establish this quickly just from that opening range. And this is the one that you will get caught out on. You will sell this, and then particularly when you fail here, that's a little bit of a clue, and then realistically you are going to be taking a loss as you come back into that opening range. If it's an open drive, shouldn't be coming back there. And then finally, open auction. Here it's a smaller one, 15 handles compared to the others that have been much, much larger. This is 26, this one's 40, this one's 60. 15 handles, open, we trade up, we trade down. So at this point, you could have an open test drive, but you don't get any continuation, and we move back into the middle of the range, back through the open again. This is now starting to look like an open auction, if not maybe an open reject reverse. It's not that. We then go and trade lower, and once again back into the opening range. It's very clear that this is now going to be an opening auction. So essentially the trade on a short time frame within the initial balance becomes very, very similar to the trade within the entire day. based on the type of initial balance you get. But this is a great way to try and either play within the initial balance for a certain movement, or at least start to understand what the initial balance is telling you about the rest of the day. So we now know what the different types of opens are, what a different initial balance means based on its size, based on the way that it starts off from the opening range to its full structure. Next up, you then need to take these, because understanding the initial balance is great, but you then need to start to build a process to identify your opening plays based on what the initial balance could be and also where this is occurring. Because where an initial balance occurs, one, likely influences the type of initial balance you're going to get, that certain initial balances are more likely in certain areas. For example, opening within range, within value, you could quite reasonably expect a higher chance of an open auction. Whereas if you open with a gap up, an open auction becomes a much lower likelihood initial balance. So you're able to assign a likelihood to the type of initial balance, but then also look at where you're currently trading to try and understand what information you're gaining there and potentially what trade you have straight off within the initial balance. So what you're trying to do, and I'm going to try and sort of create a bit of a framework here, a process to judge any kind of open and gauge the information that you're getting. Now you can have three places that a market can open, and what you've got to try and do is balance the information that you get. The first bit of information that you can judge from an open is where you are relative to previous range and previous value. So whenever you're coming into a day, you can look at where you're opening and say, right, we are either inside value, inside range and outside of value, or outside of range. And each of these has a distinct implication. If you open in inside of value, there's no new positioning. The market is happy where it was within value. So this is telling you that the market remains balanced. And you're not going to get a directional bias, apart from perhaps given by the initial balance, until you get outside of value. And even then, the initial balance is going to have to get you outside of value. So this is a wait for more information. This straight away tells you that trades straight from the open are not a great plan. Next up, you can have an open in range outside of value. What you're now looking for is information relative to value. You could get responsive trade back to value or an initiative and continuation. So you could have an open test drive, you can have an open drive from here. And then if we do trade back to value, so you get responsive trade that takes you to value, what happens there? Do you then get counter responsive trade from value, or do you get the initiative and the sweep through? So it's about asking yourself, well, what happened previously? What happened when we were at the top of value on previous occasions? This way, you're now starting to form an idea of, right, I've got decision points very clearly. You open in range outside of value, you have a decision point at the extreme of value. You also could have a move that takes you straight away from that and shows early initiative. So there's potentially trade here. But what happened previously, how the structure of the previous day is formed, gives you the real information. And this is where your opening play could come in, and something that we're going to look at in a little while. And then next up, you have open outside of range. Nice and simple, this is a gap. So you're opening with a gap. First thing to think is assume continuation. You open with a gap up, you assume that this is bullish. The market being able to gap, it's clearly got reason to gap up there. And as a result, is telling you that this is a bullish market. It hasn't even traded there, it's opened there. That's a very bullish signal. So let's just assume we're on a gap up. You assume continuation until the gap is filled. We've talked about this previously. Equally, there is responsive trade from the gap. So you fill the gap, you expect that to create responsive trade. And as a result, you can be looking for liquidation, or you can be looking for a failure to the upside. So either you will open gap up, liquidate up, open drive, or you could see an open test, drive back down, or an open reject, reverse back towards the gap and fail, or back towards the gap responsive trade and away. So again, you can use that gap and the reason for the gap as a potential reference or reason to take trade on. So having an idea of where you're opening is going to give you immediately decisions to make. So straight away, you look at where you're opening and say, right, I know that there are certain decisions I need to make. I know there are certain points that I need to be interested in. So we're going to have a quick look at an example here. What we've got is a situation where if we take these few days in a row in this little sequence of trade, moving from here all the way through to the move back down here, what we're seeing then is a situation where you open inside range on the back of a reasonably directional day, albeit with the close inside the value. So if we ignore the previous closes, we look at where we are opening. Opening inside previous value. So straight away, you know that one of the decisions you're going to have to make, or one of the decision points, is what happens when you reach the bottom of value or the top of value. Because until you get beyond those points, you can assume that we are still reasonably balanced. We are still accepting trade in this area. Large broken value area suggests also trade within this as well. So as a first trade, you get the opportunity to sell on the break, and that's this move down here, this early drop, red candle down. That gives you the chance to go and break the recent low, fails, and then responsive move back into value. So the market cannot escape value. Later on in the day, a bit of news drives us higher, and we then create single prints and trade higher for the rest of the day. So next day, different scenario. Next day you come in, open above value. So what does this now mean? Well, this does give you a directional bias to the upside. So if you kind of stack the information, the open above value is directional bias to the upside. However, you also can be interested in the retest of previous value. Do you get responsive buying from there? If we don't drive straight up, then previous value could be a point of interest for you. So what happens down here? Reaction. This gives you a trade. This gives you a very clear trade as well. You can buy from the previous high, previous value area high, down towards VPOC. Anywhere in this zone provides a decent entry point, which allows you to then play back up, essentially to fill this zone in, and also to trade up to the top of this poor value area. So responsive trades you can look for there. Alternatively, you're looking for a break towards the upside on the basis of escaping previous range. When this fails, you get another balance. So on the back of that, we then go back to opening inside value. Same again then. What happens on the breaks of value? Failure. And we get responsive trade from the same place that we did previously. So you're coming into a market that puts in an open auction, trades both ways across the open. That's what you're seeing in here. Trades both ways across the open, no direction, and the market then, even on breaks, fails to keep move going. Responsive trade falls back into the middle of the range. Direction is unclear. Now we get something different. Open above value. What happens when you get to the top of value? Immediately open, test, and then we drive up. This allows for the market to trade higher. This is the move that you get. Open, test, drive. That's the blue candle, the blue line here. That sends us up. So market's got direction now. It shows a change. It moves away from accepted value, and that could have been seen or at least looked for very, very early on, straight on the open. Next day then, we open below value. So after having moved value up, we open lower. So question straight away here, what happens when we move to value? Can you hold inside, or is this a responsive move? And in fact, early on, we do hold inside. And so on that basis, the only information you're going to gain now, once you've held inside value, is any move that comes back out of value. Once you come back out of value, and particularly if you can break the initial balance low, this then changes the perspective. This then allows for directional move, but this only occurs with news. Those who are eagle-eyed out there, this is the double distribution day that I gave you as an example of a double distribution, a strong double distribution at the end of day types. Open below value, test up inside, can't stay up there, and then news gives you the double distribution away. Otherwise, this would probably have been a day where you get inside of value and stay inside of value. It's about having this framework of when you see where the open is, immediately you know where the points are that you need to be interested in, where you need to be asking yourself, what do I want to see or what do I expect to see at these points? So that's all well and good. That's your opening info. But one of the other key bits, and this is all leading towards a play at the open, is where you're closing. And we saw a brief example of a close being important just then. And when we look at the next examples coming up, you will see why this is the case. Now, the nature of the close is important because, as we saw with a neutral day, it tells you about the strength of a potential move. and then next lead on. So, if we have a neutral day that closes at the extreme, this implies that buyers are still maintaining some degree of control. But that's not the entirety of it. Just closing at the extreme isn't all of the information, and you've got to look at it relative to where the market's been trading recently, and this then allows you to understand the propensity to either reverse or to continue any kind of movement. So, different types of close. You can only get two closes. You can get a close inside value, you can get a close outside of value. But the shape of value and the close then create a different situation. So you can have different scenarios. You can have a balanced market and a close inside value. This tells you very little. It tells you the market is happy where it is, acceptance. You can have an imbalanced market with a close at the extreme. So this would be something like a trend day, imbalanced, but a close still within value, a wide value area, and close at the extreme. This shows distinct strength in the direction, is a very high conviction day. And then finally, you can have imbalanced value and a close in the middle. A bit like one of those in the previous example where it can't sustain movement. And if you have imbalanced value and a close in the middle, you are likely to then balance this out and it loses some of that directional strength. So all of these imply acceptance. And all, whilst they might maintain a directional bias overall, generally lead to more of a filling out, generally lead in the example of a trend that closes at the high to a more balanced day before then perhaps another continuation. It's where you close outside of value that we're interested in terms of having an early trade. Closing outside of value potentially indicates a stretched market. Now, if you have a balanced neutral day and it closes outside of value, this is a neutral extreme, and that gives you a directional bias. Likewise, if you have a double distribution that hasn't moved value up, let's say with the distribution higher, that can still imply continuation with a close at the extreme, even though it may well be a long way from value. Where we're most interested in an early trade opportunity is a late move extending the range. This is where you don't get the close within what was the previously established range, but the move into the close extends the range. This then is a movement away from established value and away from the established range. This is a stretched move. These are people participating late on in the day and driving the action only late on, essentially not giving the chance for that responsive trade back because there isn't time. These are weak positions. These potentially can get reversed, and this will lead us to a trade in just a moment. So, what we're going to look at here then, relative to the close, what does this mean? Here you get a close inside of value, reasonably balanced value. So this suggests we can go either way. The open higher, good news. This suggests that we've at least now got a directional bias and you're interested in responsive trade when you come back towards value, which you get, and we move higher. Only for then more news to create a kind of double distribution type movement down. Now, this time, close inside value again, but at the extreme. This maintains directional bias. Value shifted clearly down, close inside value at the extreme, your view is down. So when you get the open and trade up, you're going to be less convinced of buying at this because of the fact that the information from the close suggests down. Once you fall back inside the initial balance, you can view this as a failure and the potential now to trade down. Close on a directional day but mid-value. This isn't so convincing and would imply that we're not convinced on the move down, and this may well need to balance out, which is what happens. We balance this area out, we end up with a reasonably muted type day, which initially produces a rather balanced looking day. That makes a fair bit of sense. This balance fills some of this out and that balances these 2 days out. But then you get the late move, close at the extreme. That is a close out of value. At an extreme, there's value. There is no volume done on this move up here. This implies late positioning. These people have forced the market higher and not given it the chance to roll back because it's run out of time. The next day then, if you fall back inside the range, this is where you can get dragged back to value. This is a scenario where you have this cancelling out. This is actually a weak indication that the market should go down, but the gap up is a strong indication. So you now, and that explains why you get this two-directional trade, because it's going to be people looking at this for a reason to go down, people looking at this for a reason to go up. Two directional trade, sellers win as you fall back inside range. We react once, fail to materialize and move up, and then you get the reversal back down. Once again, close outside of value though, and that then implies the next day back to value once again. So you see how the close tells you very quickly about how you might be wanting to interpret the open. So it's not just as simple as it's the open inside or outside of value. So what does the close imply immediately anyway? And the final bit of information in the what happened before. So we're looking at, where's the opening trades, but you need to understand what's happened before, so you can build all of these pieces together so that you know what to do at the open. It's not as simple as just, we're opening their trade. The other bit of info that you can look at is overnight sessions. So the outside of the cash session, because bear in mind what I said about when most of these sessions open, almost everything now, Eurex and CME, they all open in the middle of the night, UK time, around midnight, late in the evening in the US. So you're looking at around 8, 9 o'clock in the US. So really the opens, you're looking much more at the cash session open. So you can then look at the overnight trade. What's characteristic of overnight trade is that it's generally lower volume. You will not get the other time frame participants because they need liquidity. They want liquidity to get their positions done. They don't want to be trading when nobody else is trading because it makes it very hard to get their trades on. And so this is generally lower time frame participants. This is generally your shorter time frame traders trying to take advantage of some smaller movements. Therefore, any directional move can be considered vulnerable or less significant and able to be reversed. So now you can start bringing in an extra piece of information. How does the overnight trade move the market relative to where the previous cash session was? Is it creating a gap on the cash session? So if the overnight range trades within cash value or within the cash session's value, you're not seeing any change in movement. And so this is considered pretty insignificant. It is like a close inside value followed by an open inside value. Nothing's happened. Market's still happy where it is, acceptance. So we're not interested in this in terms of creating an open in play. Outside of cash value. Now, this does create a reference for continuation. So if you've had the overnight range does trade away from value, then this creates a point where if that is broken, you could then see continuation from. And then finally, a directional move away from value. Remembering that this is a vulnerable move created by shorter time frame participants. It acts similar to a close away from value. It creates a gap, yes, but that gap may well be vulnerable, that if it doesn't continue and maintain the direction, then those vulnerable overnight participants may well be forced out if the market starts to turn back to where it came from. If you see that responsive trade, so response to the gap, that can then send the market back, and it creates a similar situation to a close away from value. The fact that it's traded to that point does change things slightly compared to a close away from value, because it does suggest that there is some reason to be there, and as such, with it being a gap as well on the cash session, does imply continuation. So it's about judging the early trade, very early trade, to decide whether that is going to create continuation or a move back towards the cash session or towards cash value. So there is a slight variation there, and it requires seeing how that opening range plays, seeing how that opening initial balance starts to trade. That's where your information is going to come from. So here's a couple of examples of overnight sessions as well, and also treating them essentially like an initial balance. That the same size principle applies. Large overnight sessions are going to limit the scope of the main session. So I've got the red is the overnight session, blue is the main cash session. This is an S&P example. The 29 handles, 94 handle cash session. 60 handle overnight session, 55 handle cash session. And this is a great example of an overnight session that continues away from the cash close. There's your cash close. Overnight session continues away. When it can't sustain direction, i.e. continue trading down, we then get trade back. So if you look at just the cash session low, we trade straight back to that, essentially filling the gap. And this is because the gap has been created by this move here, this sort of late move in the overnight session, which is essentially the European morning, this late move down here is then reversed back because this is not done anywhere near the same level of volume that the main cash session does. And so what you're looking for here, gap rule does apply. So we open down here, your first thought is we can continue lower. But when you fail to keep going, you fail to go through the overnight low, then you can look for the reversal back to see if we can get responsive trade from the gap. So the size applies, so the size principle applies, large overnights limit cash session moves. Also, directional overnight moves act the same as a close away from value, whereby we're moving trade with much less volume. And that lack of volume in the movement is what then suggests that this is a move that is unable to keep itself going. Right. I talked about the idea of these reversing. So we go back and have a quick look. This directional overnight move is then reversed. It creates a gap, blue session to blue session, and that gap is not then reacted to and continued, and you get the drag back. Whereas what it can do, large overnight sessions can create gaps, and this can then allow for another continuation move. So in the first example, what you have here is gap up on the cash session, open test drive, double distribution type day, just about low volume there, distributes above. And what we then have is another overnight session where we trade higher once more. So this creates a gap up. This is overnight, and so whilst you see the volumes look reasonably high, this is because it's scaled. So the actual volume at price here is going to be way lower. This VPOC may struggle to be as high as perhaps that little bit of volume just in there. So the difference is very significant. But once again, open, drive in this instance, it's as soon as you break the overnight high, and this is the significant bit, that until you break the overnight, or as you break the overnight high, the idea of reversing the overnight direction is not there. And you have to view it like that. That yes, this could be vulnerable to a reverse back towards the previous cash session high. But when you break the overnight high, in this instance on a move up, and don't roll back below it, the overnight high provides you a continuation point, provides you essentially a reference where, as long as we're above here, the move can keep on going towards the upside. So let's go and have a look at a few trades, opening plays that are available. First up, a caught in the hole trade. So this relates to a close outside of value. This is a stretched market reversal essentially. So what you're looking for, key characteristics of this, you need a close at the extreme after a late move. You want to see very little volume done in that move. So you get no shift in value, and therefore that move can be considered weak. If we look at the profile here, what you end up with is value down here, so we're looking at this cash session, value lower, followed by this late drive towards the upside. Distinct lack of volume in this last move. We do jam some volume to the high. That's quite typical for the S&P, but often for other markets you will see this very light move up. Now put yourself in the shoes of somebody who has bought this very late on in this move up here. What are you thinking? You trade it into the close and hold that position overnight. What you're hoping for the next day is that the market opens with a gap up or opens and drives up again. If that doesn't happen, these people, knowing that they bought late and knowing that value is below them, are not going to hold on. And as such, this provides a trade straight from the open. The idea of the trade is that if you open inside range, you're going to get responsive trade. That the market should be back down here inside value. So you open inside range just there, and you're looking for responsive trade straight back. And the simple way to play the trade, so if you're looking for a kind of basic formula, and you have to then, and we will look at examples of this, you have to then take that and work out how exactly you can play it. But the basic concept of the trade is that if you open inside range, the responsive trade is going to take you back to previous day's value. That's this move here, which is this move here. And it does. As such, as long as you're inside the range of the previous day, you're right on this trade, or potentially right. Therefore, you could place your stop above the high. So in simple terms, you sell, in this case, sell at the open, stop above the high, target value area high. There's your trade. Expectation is this should happen reasonably quickly from the open, because people who have got caught trading that move up will exit early. If they don't see the continuation, they'll start to get out, and that's what takes the market back down. Where this trade becomes difficult is if you open outside of range. So you have a similar type structure, close a long way from value. But if this gaps up, it's much harder now to define a stop. Because if you open inside range, your stop is clearly defined, it's getting out of the range. If you open outside of range, your stop is much harder to define. And as such, you now need to wait until you have a failure to continue that can give you a reference point in order to place a stop. Alternatively, you can wait to see if you can get back inside range. Once you do that, then you can play the move down. So it's about understanding how you can play the trade. So the idea of viewing opening plays like this gives you the concept of what can happen and what should happen. Then you have to work out in each situation, because no two situations are identical, how exactly you can play that trade. And I'll walk you through a few different examples which are going to require different versions of how to enter. So this is what I call a classic caught in the hole with a varied risk. Because in this situation, the initial idea of this trade, so this is one in oil with a stretched move into the close. You can see where all the value is. There's your late move with a close higher. There's your caught in the hole. So identified, your aim on this trade then is to sell it as long as we open in range. So we open in range, just here, which is just this candle just here. We open in range, wonderful. And your target is down here. So that gives you around about from the open down to the target, about a 30 tick target. But on the basis of your stop being above the high, your stop is going to have to be from 62 above 82, so you're looking at maybe a 25 tick stop for a 30 tick target. That's not a very palatable risk to be taking. So you now have to vary how you take this trade. Either you vary the entry or you vary your risk. So whilst you have an unpalatable stop above the high, look at other reference points. You've got a little bit of volume stuck in here and the close. This could give you a stop of around 10 ticks by placing your risk here. Yes, you're not going to be completely wrong. If it trades there, it could still fall, but you're not then opening yourself up to a much larger risk. Alternatively, you can wait and see if we trade up and then try and sell it higher to play the move down. The difficulty of approaching it in that way is that you may not get the chance to sell it higher, in which case you've completely missed the trade, or it will trade higher and then won't reverse. So you have to then think about how exactly you're going to try and play this trade. One way to do it, if you're going to wait to see if it trades higher, if it trades up and then trades back through the open, now you've been given a stop and now you can sell it on the way back through the open. So it's thinking about how you are going to actually execute this trade, what the risk is that you're taking in doing it. It cannot be entirely systemized, and almost no trade ever can. So that's your classic with a varied risk reward. You will also get, and this is another aspect of being able to vary this type of trade, an incomplete move. Because not everybody is going to be looking purely at the responsive trade back to value and ignoring every other bit of information. The other key bits of information may well be previous reference points, single prints, peaks of volume. And so therefore, you have to look at, when you're playing the move back, you have to also consider where could this reasonably stop. So let's go and have a little look at this example. Once more, another very late move into the close in oil. And that's this very stretched move. So we've got a really clear target down here. That takes you down to 34. The open is up at 35.24. So you've got 125 or just under 120 tick target on this trade. That's all well and good because this is your target, the bottom blue line. But there are also reference points on previous highs, secondary high, previous day's high. There are multiple points that this market could stop at. So whilst yes, you can sell 35.24, perhaps with your stop above the close, so giving yourself a 10 tick risk for a 120 tick target, you also have to recognize where this move could stop. Are people going to come in and buy it at some of these previous highs? Quite possibly. And as such, you then have to have these decision points on the way down. Even if you stop at the first high here, you're still looking at a 70 tick winner for a 10 tick risk. So the trade is still viable. But you have to factor these bits into the value of this trade, because if the first point where this could stall, it was only offering you maybe 10 ticks, you have to look at that and say to yourself, right, am I better to let it break that point and then sell it? Or accept that you've got to wait for it to break that point before you can really consider exiting. Whereas here, we break 34.56, fail to stay below and trade back up. You can exit as you come back up, still booking yourself a 60 to 70 tick winner. So it's about considering where else it could stop. Don't assume that it can be rigid and go straight back to value every time. Next up, a caught in the hole with a gap. This is the one that I was saying is tricky to define your risk, because if you gap up, you have the counter argument that the gap is an indication of continuation. Equally, the gap could create liquidation. Stops would go off. So here we have a situation where if you look particularly at the VPOC is right the way down here, this is where the majority of value is, and then you get this late move. So we're a long way from value. There's your target, top of value. But because you're opening above the high, it's very difficult to define your stop. So if you can't define your stop, you now have to think about how you're going to play this trade. And you have different ways of doing it. You could take this trade on by selling it straight on the open, accept that the market may jump against you, and your aim, or your kind of hope in a way, is that it jumps against you and goes back on side quickly. The longer it spends away from you, and this is where your opening range can be helpful, if you sell, so if I draw it here, if you open here and it jumps and then does that, there's your opening range. This could be an open drive up, in which case there's your stop. You don't want to hold on to that. Ideally, taking that strategy, if we open here, you're looking for it to jump and go like that. As soon as you're back through the open, now you have a defined risk. And this leads to the alternate way of taking the trade. Rather than sell it straight off, you could wait for the defined risk and now sell it back through the open. You've seen the open test, now you're playing for the drive, and also you have a defined risk. And with that, now you can play for the gap fill first, and thinking about where this can go to, you play for the gap fill first, and then potentially the value area high. And it's about adapting what you're looking for on each trade. The concept is there that it should be going towards value area high, but it could stop. It could get stuck at the gap. It could get stuck at this little point of volume. It could get stuck at single prints. So it's about assessing this as we go. But as soon as you're back inside range, and we're not really putting in any movement outside, you can be confident to stay in this trade and play for the top of value as you'll move. But the key bit to this is understanding how you can execute with the gap. Whether you sell it straight away and look for that move, or whether you wait for that move and sell it. The problem of waiting is in some scenarios, it will open and just go straight down, in which case you miss the trade. So it's the balance of, are you willing to miss the trade for security, or are you willing to take a bit more risk and be guaranteed on the trade, but if it doesn't reverse quickly, you will be taking a loss. And there's no necessarily right or wrong way to do this. It's about what you feel comfortable with and how you're going to assess this trade over time. If you're happy to leave it every time there's a gap up and wait for it to come back and accept that you're going to miss some, that is probably going to give you less losing trades, but also going to lead to less winning trades on the basis that you will miss trades. Whereas somebody who takes it every time and sells it on the gap up will take more losses, but is also going to be on more of those winning trades. And that's what you have to balance up. Is missing trades worse than losing a few? You can also have a delayed move. Typically, the caught in the hole you're looking to see go back very, very quickly. Whereas with a delayed move, the concept is still there, and this is the important thing with a gap up. If you have a gap on the back of a caught in the hole scenario, this can't just be any time you have a gap, but if you have a gap on the back of a caught in the hole scenario, so there's your value, late move. When you fall back inside the gap, then you can look for the pullback to value. And so this is a scenario where you do get this late move, gap up, and then once you create this early trade, this early initial range, this doesn't really do anything. And you're viewing this as accepting the gap up, consolidation higher, shifts value up. But as soon as you fall out of this range, break the initial balance, and then you fall inside of the previous range, this is where then the caught in the hole can be played. And you can play it from, realistically, that's potentially going to be a loss as you get caught on the first move inside range that fails to stay there, or you wait for a close inside range. Once you get the close inside range, then you can play the move back down towards the top of value, the VPOC, as your target. In the end, you actually trade all the way through value, but your main aim of this trade is more to be going to play down towards the top of value more so than anything. And this can be played much, much later on in the day. One thing we've not looked at so far, we've looked at how the caught in the hole can not work in the sense that it may not reach the target, and looking at varying how you take the trade on, how you execute that trade, and how you manage your risk. Next, you're going to look at how do you identify this failing. And so what we're looking at here then, classic caught in the hole, open down here. So there's your close outside of value, and we actually open right near the low of the day. This is perfect because you can buy this with your stop down here and your target up here. So it gives you an ideal scenario. Well, what happens is we then move straight up to the single print and close, which coincides with previous lows, and that's the end. This is why it's important to consider these reference points. This could be a way of scaling your position out. You could exit part of the position here in order to reduce risk and also mitigate the potential of this rolling back. This is on a 1 minute chart. This is the move. First minute pings us up and then we trade and stall here. What you're then looking for and what's really important is that if you then go back through the open, back through the low established in the first bit of trade, this then shows essentially a responsive move from the single prints and previous lows, which now can set up a continuation to the downside. And so a bit like the gap, failure and back to value, this is a caught in the hole, failure and continuation. And so the reference of where you open and staying above the open is crucial in a trade like this. You start falling back through the open, you run the possibility of then this turning into a failed move back inside range and continuation towards the downside. To give you another example of this, this is an S&P one. Caught in the hole situation, open, this is the overnight range, so giving us the open marginally higher from the previous close, which comes in here, the grey highlight. Open, first 5 minutes trades down to the previous high. This is your decision point. If this is to play the caught in the hole, we need to drop through here and then keep on going down. If the market bounces away and in particular goes back through the open, this is where the turn is likely to come. This is the gap element. The gap fails to get inside range and reverses up. Finds the responsive trade. So it's about stacking these bits of information. The caught in the hole tells you it's going down. The open above range, the gap up, suggests it's going up. So you now need to make a decision. The caught in the hole does mean that you can sell the gap up on the basis that this is a gap on the back of a weak move. But if that weak move then finds responsive buyers when it tests back, this is now telling you that actually this is a move that does have some strength in it and can go to the upside, which is what happens. And to break this down a little bit more, this is what happens on a 1 minute. There's your open, which you can sell. Move straight down to the top of the previous day's range. At this point, if you've sold it straight from the open, you've taken half a handle of heat on this trade, you've gone straight on side, and at this point it all looks good. Here's your opening range, open, low, and you bounce back, so potentially an open drive type scenario. What you don't want to see is it trading back through this high, so out of this little box. Bear in mind, this is still not inside the previous day's range. When it moves out of this little box, it doesn't continue on because it's found responsive trade here. That then suggests that the trade is over. And as soon as you get through the open, you then get this charge towards the upside. Liquidation move up, fast drive higher, and then further continuation on from there. This does give you the chance to play that caught in the hole with a gap back down. It's just when the gap doesn't get filled and materialize into a further continuation, this tells you that the move is over and the potential to go up is absolutely there. Okay, next up, we're going to look at a variation on a caught in the hole using the overnight positioning as extra guidance and as a way of trading with clearer parameters, with defined risk. So with these types of scenarios, this is a situation where you're playing the move when you have a gap, cash session to cash session, but you're using the overnight trade to help define how you're going to play this. So we're now into the section, of course, on what can happen. So rather than, we can see what's previously happened, what can happen, and how you're going to take the trade on. So what we're looking at here then is essentially out of hours trade, the light blue line. This stretches, this takes the market in one direction. So you trade above or below the previous cash session, and you're looking for the majority of trade. So in this scenario, you'd be looking at, say, the cash session high is here, and this is where most of the trade is. Whereas if the cash session range was, say, here, and you trade overnight down and up, that's less significant. You're looking at a clear directional move in the overnight session. What then happens, just like a caught in the hole, is these participants need continuation. And if they don't get it, they don't get affirmation from an other time frame participant, i.e. buying on the gap up, they're going to give up. And so what you then end up with is a situation where responsive sellers, seeing the gap up thinking, this is too high, we can go back, join the profit-taking overnight buyers, and everybody's looking to sell, which is what drags the market back down and fills the gap in. So how are you going to play this? This is a reversal to fill the gap. So what you're going to be looking for is if we fail to break, if that's the overnight high, the red line, if we break that and fail to keep going, fall back below the overnight high, that's one area or one trigger to play the move down. Stops can go above the overnight high. Alternatively, if this is the open cash session, on the move back through the open, like that caught in the hole that fails and reverses, you can then play the move back down from there. Each with your stop above the high that's established here. This back through the open is a way of taking the trade on when you don't even reach the overnight high. Not even reaching the overnight high is a pretty clear indication of a market that doesn't have the ability to sustain direction. So let's go and have a look at a couple of examples of this and how these can be played. Excuse me. This is a much more limited one, and an example where you have a cash session and not really a very directional overnight session. From the cash close, we trade down, we trade back up. It's not massively directional, and as such, this would be one that is, whilst it works technically, but if you sell at the open or after a little spike up, it does go back and take the target. But the target's minimal, and the target is always the gap close to start with. The gap close, or the price gap close, and then the close price. So the close price being here, and then the price gap there, hence the box for a target. But because of the lack of direction in the overnight, this would be one that you'd dismiss. So whilst it works and it's tempting to say, look at a great example, that would be dismissed on the basis that this is not directional in the overnight, so therefore you don't have this sort of pent up overnight positioning that is vulnerable to reversal. Whereas in this example, here's your cash session, close down here, overnight continues. It's very, very directional. Value shifts clearly lower, whereas value is broken on this one. Value shifts clearly lower. Now you're in a situation where come the cash open, you can look for reversal. And so what you're looking for, you don't want to buy straight away, because if you buy straight away, your stop is all the way down here. So you can look at this from the open. If we test down and go back through the open, now you can play along as you go back through the open. Alternatively, you can use the open as support and use the low of the current cash session as your stop. This creates a much more clearly defined stop, a smaller stop as well, which gives you about 4 handle stop, still with the same target to fill the gap in. This is a reasonably low volatility period. This whole cash session range to get all the way back up is 30 handles. It's not a huge one. But The idea there being that you're using the failure to go one way back through the open is your indication that this can then reverse that overnight positioning. Another example here, this is an overnight reversal of direction. And so whilst the overnight move is still well within the pit session, so this is an oil example, here's your pit session move, all of this here, the overnight move just reverses that. So it doesn't actually really move you outside of the previous pit session range. It does open slightly lower on the next day session. But there's your pit session close. And you then get this very quick attempt down, breaks the overnight low, straight back. As soon as that's happened, you can play the long from the overnight low or back through the open. As soon as you play back through the open, you can then play for the price gap, which is here, but bearing in mind that the close was all the way up here and you had this big sell-off in the overnight, to reverse all of the overnight trade, you can then play for the full reverse of range, or at least to look for the bottom of value and then the movement through what is a poor value area. Now, of course, the poor value area is what helps this, but the initial trade is to look for the overnight sell-off, failure to break the overnight low gives you the chance for the quick reverse, and once you're inside range, i.e. the gap down has failed because the gap down is based on the overnight sell-off. So on the whole, the previous cash session, this is a strong day. Open down here, close up here, that's a strong move. And then for the overnight to turn it around and create a gap down, these sellers need continuation. They've created a situation that looks extremely bearish, and so if they don't get the continuation move down, they can then get reversed back very quickly, which is exactly what happens here. Similar scenario, but a continuation one. So this is a continuation in the overnight session. So here's your cash session, move down, close, continuation. This is the bit that we're interested in. So here comes your cash open. And to start with, this is not that clear. There's your opening price, that little black line that I've drawn. And to start with, you're waiting for the movement. You don't break the overnight low for a little while, and then it breaks. Once the overnight low breaks and you fail to stay down, there's one clue, that's one way of playing it. Or you play it as soon as you go back through the open. Back through the open, now you can play up. The difficulty in this one is it comes back again. That's potentially going to stop people out if they keep their stops tight below the open. But the idea of the trade is still there, and this is what you have to remember sometimes. Even if the trade doesn't work, or even if you do get stopped out on the pullback here, the trade's still on. It's still a viable trade, and so you can still then look for other entries, look for alternate ways of taking the trade on. So it's not always to say that the trade must be taken a specified way and will always work. Even when it doesn't work, the objective works. You do get the gap fill, and it's about then recognizing how you can play that, how you can make that trade work. That's the bit that you're interested in this. So far, we focused on CME products, so I looked at oil and S&P. And what I talked about at the very beginning with initial balances is the idea that the Europeans, or Eurex products, have a distinct pickup in volume at 7 and then even more so at 8. This is what you see here. So whilst the 8 o'clock volume kind of dwarfs the 7, the 7 o'clock volume is notably larger than what has preceded it. So what you can have then, and what you have here, is an overnight session move. So this is running from midnight to 7 a.m. Overnight session takes us out of a very, very balanced market. So completely balanced market, we drive away from it. At 7 a.m. then, we open, trade up, fail, straight back through the open. So this is creating that gap on the back of overnight movement away from completely balanced market. It's about piecing these stories together. This is completely balanced. If the gap up does not bring in buying almost immediately, this is a move that could be in trouble. That these buyers, particularly as they come in very, very late to the move, so in the last sort of hour of the overnight session, because they come in very late and don't sustain direction, 7 a.m, failure to break the overnight high, you start the reversal. The reversal gets you back just inside range. 8 a.m. then opens at the top of the previous cash session range, and then you get the drop straight the way down. Doesn't create any movement up because the overnight buying is not strong enough, the 7 a.m. move has already shown early responsive trade, and that early responsive trade is leapt on during the cash session, and you then get that sell-off, which in fact then sweeps the range of the previous cash session and creates a liquidation type day. That liquidation is the liquidation of the overnight buyers, which sends us back down and creates this B-type profile. I'm going to stop there and I'll record the last bit, which is the gap opens, which will then also go into or creates this opening place sequence. So there'll be 3 videos that need to be merged into 1 video. Final opening play type then is a gap open. What are you thinking about with gap open is what's caused it. And there's going to be a few factors that cause a gap. Either news, correlated moves, or overnight positioning. So you've got to assess what has happened to create the gap, in terms of that then telling you whether this is actually likely to play out as a continuation or not. And we know what gap rules are. We talked about these in the earlier week. A market that gaps, you assume continuation until we fall back into the previous day's range. So we're going to cover a few different examples and how to try and approach different examples dependent upon the structure that was there prior to the gap, and also what caused the gap and where the gap is actually gapping to. Because if you're not gapping out of a wider established range, the gap isn't quite so significant. So that's your first question. Is it news driven? Is it correlation driven? Is it positioning driven? And your next question then is also, have we actually moved away from where we're currently trading? Because unless we've moved away from where we're currently trading, it doesn't really change a great deal. And this is where understanding the bigger picture comes in. And when we look at mapping, that's going to become a little bit more clear. So what you've got to try and do is, the gap is a chance for a reassessment of current value. So it's the question of whether the gap is going to bring in enough initiative or initiative to continue the move, and people who are going to react to the gap and continue to trade to move value. Is the gap going to move value for you, or is the gap merely a overreaction to something, and then the reassessment is that that's too far and the market's going to come back? So you're looking for situations where we're going to get continuation or we get the responsive counter trade. Now, certain situations, news gap is going to be one where you assume, at least initially, that you will not see the responsive trade. Reason being, if you've had news and that creates a gap, why would you, let's say it's a gap up, why would you sell rather than at least wait to see the first people rush to buy and then sell into that? If you think about the news gap, people are going to look at that news and say, right, the market should go up. They're assuming this is news that creates a gap up. So people are going to react to that. People will be forced out of positions. I'll give you an example in a moment. And when that happens, as somebody who's going to be a responsive seller, somebody who reckons that the gap is too far, you're still much better off to let that play, that first move, and then sell it. So in certain situations, it's about the opening range. It's about understanding whether that first move is then going to allow for a further continuation, or whether that first move is the continuation, and that is all. You want to see high volume. If you don't get high volume, you have immediately a situation where you can doubt the gap. Certain trades, you can play it straight from the open as well. And this is what, and going through a few examples, we're going to be specific on when you want to be playing straight from the open versus when you want to be letting this initial opening range play, the first 2, 3, 5 minutes, let that play and then transact. So often, in other situations, particularly when it's not news related, waiting the opening range to form and either playing the break or the reversal becomes your strategy. Let the market accept where it is and then work from there. You want to find out, let the other people do the jumping in and jumping around in, out, in, out. Let them do that, and then you can assess based on that whether you feel there are enough participants to keep a move going or not. And then you've also got your back through the open play. That's your overnight positioning trade. So, first trade, and these are the only real true gaps that you get anymore. It's the Sunday night gap, and when we look at crisis trading, we're going to look at this in more detail, and I'll give you an example of one of these and how these play out. But Sunday night Globex gap, this is one of the few situations where you have a full 2-3 days to receive some news that can create a gap. Otherwise, the only gaps will be formed in a 1 hour period between 10 and 11 o'clock in the evening, UK time. So, 2 types of gaps then, really, on news at least. You're going to get your Sunday gap. This is news over the weekend. Example here, this is a very recent one, beginning of 2021 in natural gas. This is a trade that a lot of people are starting to look at this point in time because of the escalation of tensions in Ukraine. Talks had happened over a weekend and nothing had concluded from it. So essentially the situation had not improved. It got slightly worse. This gives you 160 tick gap up. Anybody who felt that we'd run the course and was starting to roll back is then in trouble. Gap, market charges straight to the upside. This is a 1 minute chart and you see instant run to the upside. And this is why waiting for that opening range, if you're somebody who thinks this has gone too far, is important, because the opening range forms just here and then you get continuation. This means that you simply just don't play the reverse. And if you don't necessarily have to be on the move up, but you don't play the reverse. You can also have a cash session gap. This is news that comes in on the overnight session, moves the cash session to create a gap from the previous, and then the reaction to that. When the underlying assets start to trade, they're going to be opening with a gap, and so people react to that, which is what creates a similar type movement. So when it is a news related move, the assumption is straight away that we are going to keep on going. And so this is a situation where the strategy comes down to execution straight on the open. And it's difficult to do because your risk is, in a sense, undefined. It is defined in that your risk is here, but taking 160 tick risk is not what you want to do on your first trade of the day, first trade of the week. The way you want to be approaching this is, and the way to think about news, if the news is significant, the market will go straight off. Because if the news is significant enough to push the market up, people who want to buy will act immediately. They have to. They're not getting these prices here because of the gap. And so therefore people enter immediately. And if you're not seeing that, that is a massive clue that people don't really believe the story, or at least don't feel that the story justifies the size of movement. Whereas for the reversal type move, you wouldn't expect it immediately to drop. And as a result of that, this puts then the onus on execution being instantly on the open. That's going to be your first trade. And that's what you're looking for on your news or Globex based gap. Immediate action straight on the open. And then there's going to be a reassessment. Once you get stabilization, this is the point where either you're going to get the continuation or the reversal. But not all gaps are news related. And what we've got here then is a look at a gap up caused by an overnight session move. So we've got a little bit of an overnight session move. So the other part of any kind of gap is understanding, well, what's taken us here and have we really changed anything? And this is where structure comes in. On a news-based gap, it's all about acting according to the news immediately. You take that first move and then reassess. Whereas in a situation like this, there's no need. Because what you've got to ask yourself is what's the structure? What's happened here that's created this gap? And has this gap actually changed anything? So what has happened? We have a gap up. This is where we've closed. That's where we're opening. So clear gap up. It's a gap above the previous day's range. It's a gap from the close. But in a wider context, and this is what you need to consider, wider context, this gap up is still well within the previous traded range that you can see over the last couple of weeks. Sorry, not over the last couple of weeks, last couple of days. So we've not even gapped out the last couple of days' range. You've also got to consider what happened on the previous day. The fact that the previous day put a bullish move into the closing suggests that this is a move that is really just a continuation of what we saw at the end of the previous day. And so the gap is less a gap that needs to generate more action and is more a gap that is based on a continuation of what was previously happening, i.e. nothing changed, so the market kept going. The other factor as well that you need to consider is where was the previous close? What happened to create the move? So in this situation, we go and look at what happened. And this is what I call a camouflage caught in the hole trade, which creates a gap. So what we've had, previous day sells off. And to start the day, this looks like a reasonably solid move down. You have small initial balance, single prints come out of it, second set of single prints. This is what you would call at the time a machine gun move. We'll talk about this in more detail coming up. This sort of machine gun trend type move. So you've got a pretty steady move down. And by the end of the day, we've then reversed all the way back up. But if you look at the final move here, this is done on light volume. And that light volume suggests that this is not the strongest of moves. And this is a move that can be doubted. And this is why I call it a camouflage caught in the hole. That the established trade down here is then suddenly driven away from in the last hour of light volume, essentially dragged by the US close. It's not a Eurex trade, it's not a European stocks trade, it is a US close. It's a correlation move. So immediately you can doubt the gap because you can now see that this is clearly a correlation, not a genuine, not a move based entirely on the fundamentals and technicals of stocks. So you have that. The gap up doesn't get you outside range. So anybody who's still in a position within this range doesn't need to get out of trade. And so it doesn't create the necessity for early action. And this is where you immediately see this open and pull back. And you can then look at this as a situation where you don't want to be involved immediately because of the inputs to get to the gap. It's a camouflage caught in the hole. There is no news. It's a correlated move up with the S&P. All of those factors suggest to you that this isn't a gap that necessarily is going to keep on going. And this is where, using a simple rule of gap, assume continuation, you can look at the facts going into this and say, well, gap, I probably don't really want to look at this as a continuation move. Whereas here, this is going to be a more realistic gap and one that you can look to play straight off. So this is a cash session gap using and looking at this in the DAO. So this is one of these trades where you're going to play this in the cash session. And what we're looking at here then is a neutral day. We talked about neutral days on day types, that this means we can go in either direction. And in doing that, we now have a very clear idea of where a gap creates an impact. Because anybody who's positioned in here is in trouble on a gap. And this is likely to cause a quick liquidation move. When we get on to specific plays, this is what I call a 2-day reversal trade. So you've had the steady sell-off. This is your trend day down here. You get your neutral day, which balances the market out. This is where a gap's going to be important. Because if you get a gap up now, and this is a gap into the cash session open. Cash session now opens up. Anybody short is in trouble. Liquidation trade comes in. Anybody who's long in here has just been shown a really, really strong bullish indication this market can go higher with the gap. And this is what gives that very, very fast run to the upside. On something like this, and particularly when you can sort of measure your risk quite tightly, you've got a risk in this case, and a lot of trades are about asking yourself, well, what's the risk that I'm facing? You've got a 25 tick risk. It's not a small risk, but it's a trade where there could be some value in playing this straight from the open because of the situation. So when you're thinking about risk, we'll do more on risk management. When you're thinking about risk, you have to say to yourself, yes, this is perhaps not a risk that I'm willing to take full 25 ticks, but also ask yourself, is this a situation where I'm likely to ever get stopped out? And on the whole, the gap away from a neutral day is not a situation where you're expecting to be stopped. And so your probability of this going up is very high, and this can then give you that early chance to try and play it. You could look at this and say, right, I'm going to wait for that first initial pop, you get the initial jump, and then execute on that. That way, you give yourself the chance to define risk, and this is always tough. The advantage you have with a cash session gap is you will have seen the pre-cash trade. So that pre-cash trade you can use to define your stop. And that's the other way of doing this. You don't have to just buy straight from the open, or you can buy straight from the open, but you can define your stop using the pre-cash, the overnight session trade. And so viewing this in terms of structure, whilst the previous one had structure that didn't suggest continuation, this does. This has structure that suggests either continuation or a liquidation move. And this way you can go into it very confident that if you get a gap on that cash session, you are likely to see a clear directional move. And you can play that straight from the open, define your stop below the overnight or below a reference in the overnight session. So we've looked at news gaps where you get the Sunday night gap up, continuation. The importance on a gap like that, and I'm going to break these down for you in a moment, is being willing to act immediately and taking that risk early on. With news gaps, it should not go against you straight away. The idea is you should go straight on side. If you don't, that's a massive clue that you're wrong. With structural gaps, gaps created more on a correlation basis that other markets may have pulled you away from where you're currently trading. You have to look at how the market is traded going into it. So do you have something like a camouflage caught in the hole? Are you gapping within the wider range? So really it's about asking yourself, is this gap putting anybody under pressure? With the previous one we looked at where you have a neutral day, that gap is putting people under pressure. People who are short are suddenly offside when it gaps up. They're in trouble and they're going to get forced out. Whereas when you have something that's gapping within a wider range, very structured, non-directional market, you're in a situation where it's going to be difficult to actually keep this move going. Another type of gap that you will see, and this is a gap where technically this is one that you can go for straight off the open. And I'll show you the very short term 1 minute of this in a moment. We've got a highly volatile market. This was caused by the Omicron variant coming to the sort of general public's knowledge around about Thanksgiving 2021. This creates a huge amount of volatility in oil. And so we get a drop over the course of 3 days from $77 to $63. So a huge $14 move down. And on the back of this, we then get this volatile stabilizing move. You're sort of moving in a $4 range. This is just on a cash session. So we've got a lot of volatility, and then you get a gap down. The gap down, when cases are discovered in the US and more travel bans are being talked about, so it's an escalation of the story. The gap down breaks the recent low. This then forces more people to come in to sell. It forces more people to get out of long positions. This is where you're expecting a very, very fast move down. Technically, you can define your stop back through the gap, and you can also look for continuation. But as we've talked about with other trade types, this is a situation where the context going into it is important. Because we've had such a sell-off and we're starting to see stabilization, this move now needs to keep on going in order to be able to sustain this move. Otherwise, this is more of a exhaustion of the action, a sort of whip to the downside, and then potential for a reversal. So it's one where, as a strategy, you want to be taking this early because of the technical situation, because this is open to a significant continuation. But once that's happened, once you've got that initial range, that sort of opening range down, once that has happened, if you don't see continuation, now we're in a situation where this is going to struggle to keep on going, or may struggle to keep on going. So you can be more open to the reverse. And the reason being open to the reverse is this has had time to come off in the overnight session. This is a continuation which exhausts anyone who's been buying the dip. And then it's a question of, once that's happened, can we get continuation from here? And we're going to look more and more at gaps. As we go through the course, we're going to look at these gaps and situations where you have a gap and ask ourselves, pre-plan what it is you're going to do on this gap. So we're going to look at what happens on a 1 minute. This is on your 1 minute. Now, the difficult part of this trade, of course, is that the first minute we get this flick up. This, realistically, is a situation where you're going to lose. If you sell the gap on the break off that previous low, you're expecting this to go straight down. If it flicks up, you're likely to lose on this trade. It shouldn't be trading back through the open. But you get a second bite of the cherry. Back through the open, and we'll bring this on in order flow. Looking at how this plays out. Back through the open, now you can play this to the downside. And looking at this from an opening range perspective, there's your high, there's your low. So there's your kind of open range. And you also then get the open, reject. And now the question is, do we continue or do we reverse? So within about 3 or 4 minutes, you've found the extremes or the potential extremes. The question is now, which of those is going to be the extreme? Is this a day that's going to put in an open test drive down continuation, or is this going to be a day that is open, reject, reverse type situation? So that's the question that you're really looking to answer for yourself. As a trade, I think the play on the technical break is really important. But the fact that this has forced so many positions out, and you see this in the order flow, it has this exhaustive nature to it. Extremely fast. This puts in around about a 200 tick drop in the first 3 minutes. That's a very, very large move for oil. And so what that's showing you is that people are panicking now. This isn't a gap that is bringing in new traders. This is a gap that's creating panicky order flow. And this is what you have to look at with any kind of gap. If you've gone for it, and if you sell it on the gap and you get this panicky order flow, this ultra fast sell off, rushing to get out of trade, that's where you say to yourself, okay, as soon as this stalls, I'm willing to take the trade off. You need to find out whether there's a willingness of people to continue. What we talked about with any kind of shift away from value, this needs to be sustained. And for a 200 tick drop on the back of a gap to sustain, you need to see some kind of period of time and volume done at lower prices. If you don't see that, the market has the risk of reversal. So in playing the trade, and the gap down sell absolutely makes sense because of where you're gapping through and what the news is. But if this does exhaust like this, exceptionally fast move, then you have to say to yourself, whatever happens here, we're going to need time. Either we're going to need time to establish trade down at these lows and keep going, or we're going to, if we don't get time down here, reverse. And so this is then the point where you have to sort of consider what's going on. The slower trade will be the continuation, the faster trade will be the reversal. So that, with any of these gaps, it's almost the case that your trade is immediate or very early in the day, followed then by reassessment. And if you don't get a large move straight away, then it's a question of playing out of that opening range. If you do get a large move straight away, then it's a question of can this be sustained? In this case, as soon as that first bounce resistance is found, breaks, you get the reversal very, very quick back up. And one of the key bits here is this ferocity of the sell. The speed with which it comes off, the panic with which it comes off is a massive clue to the inability of this to keep on going. So I'll try and sort of summarize different kinds of gaps and different types of execution on a gap. And you've got three different ways of doing it. You have the straight in option. Your straight in option is going to be on a cash open gap, but generally all of these are going to be news related. So it's either a cash open or a Sunday night gap. The idea behind the trade is the news is significant enough to drive the market. If you break out of a daily range, equally, this is going to be important, and this is where structure comes in. You need to have some degree of structure where you can say, if we've been trading here and we now gap up here, this is one where you can say, right, this is straight in, or this is a straight in scenario, because the fact that anybody trading in this range is now in trouble because they've not had the chance to get out as we come up here. It becomes a liquidation type trade. And you've got news that goes with this. If you open within the wider range though, so you have this range follows on and we open with a gap within this, this is where situation changes and where your current, so if we say I had a trade like this and then we open up here within the current range, the structure that has happened here is important. What is it that's caused this gap? And why is it that it has not been able to escape the range? And this is one then where your opening range break is going to be more important, because whatever's created the gap has not been sufficient to get us beyond where we're currently happy trading. If it does that, then you're in this situation. Gap within a range, you've now got to ask yourself, what happens structure wise? Do you have something like a camouflage caught in the hole? And what's the market going to do from here? Once the opening range establishes, now you've got more indication. Now you've got reference points to play from. And you can play the break of it. If you get a small opening range here, you can play the break to the upside, which gives you the break of the wider range, or you play the break to the downside, which gives you the reversal target. And that's the trade that you're looking for. So it's always about asking, well, what's the structure going into this? What does this mean for the next leg of any kind of movement? And then you also have the back through the open play. This is going to be a situation where the gap generally on a cash session has been created by an overnight move. So you have this overnight move, let's say towards the upside. This creates a gap. If the previous cash session is the black range down here, you get a gap. So open now up here, you're now looking at this thinking to yourself, well, if this is why we've gapped up because people have just driven the market in the overnight, this is one that I can question and one that I'm not going to be entirely convinced of continuation. Where the continuation becomes more likely on a trade like this is if we've broken out of a wider range. Now you have a situation where, like with that caught in the hole and a gap that we looked at in the S&P, we could have this type of move. And this is why the opening range matters. You let the opening range form, and now you can define whether we're going to go up or down, but also you have the back through the open play. And so if you have the initial attempt up and then back through the open, now you get the chance to play here. This may be a trade, even with, say, that oil example one, where you take the initial trade and you lose on it. So a trade where if you have a gap and you try and play in the direction of the gap and the market flicks and turns back against you and you take your loss, the back through the open, once you've stabilized a little bit, so when you're not trading that very first immediate action, can still give you a trade after that. It's trading it back through the open, and that can be your entry point. The advantage of back through the open, as we talked about with caught in the holes and overnight positioning trades, is that you have a defined stop now. You know where your stop is, it's above the initial spike. That way, it makes trade much more definable, makes your risk reward more clear, and makes it much easier to assess whether you're willing to take the trade on or not. So, quick summary of opening plays. Remember, with an open, this is the most uncertain time of the day. So you will see volume increase compared to overnight. You will see much more happening on your ladder. Markets will get so much quicker, so much more will go on. And this is always tempting. It's very easy to see you flashing lights thinking, yep, I'm going to get involved here. More what you need to be thinking about is you don't need to find a trade. Everybody else is not necessarily trying to find a trade here when they're taking trades on. They're dealing with positions they already have, dealing with orders that have come in. And so that first trade is more about understanding what the market wants to do initially. Is there a clear, early, strong conviction or not? So there's no necessity to try and predict what other people may or may not do at the open. And the only time you want to be involved at the open is when you can very, very clearly define exactly why and what it is that you're looking for. So your trades have to be specific, they have to be clearly defined. And so you can almost approach an open and very quickly you've got to look at it and say, right, do I have one of these three situations? Do I have a stretched market, a positioning trade, or a gap? And the gap more so is going to be one based on news, because a positioning reversal trade is also likely to be with a gap. So do we have news that has justified this gap? And if you don't have any of these, you don't need to transact. You don't need to look for anything. And the easier and more prudent thing to do is let that opening range play. Let that first 5 minutes get underway and then play from there. And when I say play from there, the first 5 minutes doesn't tell you what's going to happen. There are other pieces of information, as we talked about where you're opening, where you're closing, where we are relative to value, how the market has moved in recent days. So you're piecing together this structure. And then the opening range then allows you to play from there towards the ideas that you have generated earlier on in the day, or the ideas you generated based on the wider structure. And so these are very specific situational trades. And if you don't have the hallmark characteristics of them, there is no trade. And you can very quickly then move on to what's the opening range and trade that. What is the reason for the gap on news and trade that. That's the way you want to be approaching it. So with these stretch markets, you're caught in the whole trade. The open is going to dictate your trade, because yes, it gives you a framework and it gives you an idea of what should happen. But you then have to look at where we're opening and ask yourself, is this a trade you can play, and how are you going to take the trade on? The caught in the hole with a gap is going to be traded differently to a caught in the hole that opens just above or just inside the previous day's range. You have to look at it as well. Ones that open a good distance inside the previous day's range, how do you manage your risk on that? Is there a more appropriate way to manage your risk? You have to weigh up what you're looking to get out of the trade. If you're playing back to value and value's 10 ticks away and the extreme of the day is 30 ticks away, you have to look at that trade and say, yes, structurally this makes sense, but as a trade, this is not a trade that you want to be involved in, because you're risking 3 times what you're going to make on that trade. And that's a situation where the open has basically taken the trade away from you. With the overnight reversal trades, this is more a trade about waiting to see if the positioning is going to unwind. And so you don't need to be so urgent. You don't need to rush into the trade here. You can wait, and you're waiting to see if this overnight positioning gets confirmed with continuation, or if it gets rejected and a failure in passing the overnight extreme, and also the move back through the open to then play this back down. And then finally, gaps. The first question you need to ask yourself whenever you see any kind of gap is what's caused it, because this will dictate how urgent your action is. If it's news, there is urgency. The market should react to that news and move off the open. If it's not news, then you need to reconsider, and you need to ask yourself, what has happened structurally? Do we have a situation where people are going to be forced out of positions, a gap out of a current range, a gap away from a neutral situation? Or do we have a situation where the gap is perhaps more likely to reverse, and you need that opening range to play out before you can then play it back down, because you're opening well inside the current range of trade? So they're your considerations. We're going to look more and more at these. We're going to bring up examples on a day-to-day basis. We can find different examples of gaps and assess whether this is a gap that is viable to play straight off, whether this is a gap that is going to be more likely reversed. And so we're going to start looking into these opening plays and then structuring trades around them so that you can trade it straight off the open, or at least have an idea of what you're going to look for at the open and then play from there. So opening plays, it's not about trying to find something every day. Much more, it's about trying to find these situations that give a clear trade, a clear action. And without that, the open is often a very choppy place. It's a place of uncertainty. Once the uncertainty has died down, now it is clear what you can do from there. So an open is either an immediate trade or it's an information gathering exercise. Once you've passed that first 5 to 10 minutes, then you can use that information and trade on from there.